So before we get into the origins of liquidity, we need to understand how price moves. And this might be common knowledge, right? So we know that price accumulates, expands or drops. So in this case, for this example, we'll say it expands, then expands or drops, then drops, then accumulates again. So we know, and so on, so on. So we know that the market usually moves in this sort of fashion. And again, what is price movement? Price movement is not about your candlesticks or your line graph or certain patterns, anything. It's just price visiting certain price points throughout the price for a certain amount of time, which would be in the representation of your time frame. So what do we know? What we do know is there's money injected for price to move. So for price to move from this area to this area, that means liquidity was injected to push price up. And for price to move from here to here, that means the institution sold. So we know that there's a transfer of money, an exchange. But what do we know for sure? We know that the liquidity is injected in those accumulations. Why are they called accumulations? Because orders are piling up. Once the orders pile up, a direction is chosen. So in this accumulation right here, there were more sell orders than buy orders. That's why price dropped. Again, let's use this accumulation, for example. In this accumulation, there were more buy orders than sell orders. That's why price shot up. And now it was time for them to accumulate again. There was more buy orders again, more buy orders than sell orders. That's why price shot up again. And here there were more sell orders than buy orders, so price shot down. So the conclusion that we can reach here is that there is money injected in those accumulations. So these accumulations will be called our bases. Money is injected in those bases. So think every time you see these bases, think of these as money. This is where money is injected. So here you see a consolidation, then price dropped. Price retraced, then dropped. Consolidation, dropped. Consolidation, dropped. Consolidation, dropped. Consolidation, rally. Consolidation, rally. Consolidation, retrace back, and rally. So basically, it's consolidation, drop, consolidation, drop, consolidation, drop, then got a consolidation rally, and so on, so on. So this is how price moves. So money gets accumulated, they make the decision, price drops. Accumulating money, decision made, drop, and so on, so on. So let's mark out our bases. We had a consolidation here, and again, consolidation, just for a basic explanation, is a rejection on both sides. So a range is created and price gets stuck there. So this was your consolidation, your low and your high. Price rejected at the extreme of the bottom and at the extreme of the top and stayed there for a little bit. So it's a rejection on both sides. So you had a base right here. You had another base right here. Another one right here. And again, we're not marking them out just because of a simple pattern. We're understanding the function of the price, right? And then here, price switched. So here you had a consolidation, and then price rallied. You had another consolidation, a low and a high. Price stayed in that range. And then an expansion was made. So what do we know here? We know that decisions were made right here to push price either up or down. So in this case, the sells were made to push price down. Here, sells were made, sells were made, sells were made. Here, bulls were made, bulls were made. But what do you notice after we mark out our bases? The price does visit these levels again. Here, it didn't make a visit. Here, it didn't make a visit. Once price broke structure here, price made a visit here. So a lot of times, price comes back to visit your bases. Why is that? So now let's take a deeper dive. So you had your base right here and you had a breakout from the base. What does that mean? That means buy orders were injected here. The decision was made and there were more buy orders than sell orders. So again, to keep it simple, there were sell orders here. But in this case, there were more buy orders. So there were more buy orders in this base than these sell orders. That's all you have to think about it. So now that we know that there was more buy orders, we know that, let's say, for price to make this move, breaking away from this base, it cost the institutions $1 sign. Now, the $1 sign could be a representation of anything, and we don't know the exact amount of number injected in a base. This is mostly assumptions, but we do know it costs to move price. Price just doesn't move for the sake of moving. So let's say it cost them $1 sign to move price out of this base. So now when price does come back, here, there is still 3 signs, right? There's $3 signs. So if there's still $3 signs in this base, what do we know? Price will reject again. That second visit will still reject. Why? Because there is still money left in this base. So let's say for this move right here, it cost them $2 signs. Now it costs them $2 signs to make this move. So now we know this base only has 1 sign left. And let's say price comes back down again and rejects with a smaller move. That smaller move cost $1 sign. So what do we know now? We know all the money that was in this base right here got used up for this motion. So what happens when price does come back for the third time to visit this base? Price will break through it. Price will not respect this base anymore. Why? Because there's not money left in this base anymore. And this is where your liquidity plays in. So when you see equal lows or equal highs in your chart, always look to the left. Always look to where they're derived from. So in this case, you're seeing 2 equal lows. And you're saying, okay, this is liquidity. Understand where this liquidity came from. This liquidity right here came from not only price being bought by retail traders here with their stops. Retail traders are not a strong factor enough to move market or to induce the market to take them out. This will be more of 2 birds with 1 stone, right? The market, the institutions come in first. The function of the market comes in first, and then taking out the retail traders would be the second objective. So here, this was your base. This is where the money was injected. As you can see, price came down, rejected once, used a little bit of money for this move, came back again, used money for this move right here. So when price does come back to this level right here, or even for order block traders, right? So let's say you are an extreme order block trader and you have an entry right here. There might not be enough buy orders for you to get the move that you want. So you would want price to reject from this area and continue up. But there might not be enough area because the origin of this move right here is this liquidity. And the origin of this liquidity is this base that we know has already been used with these moves. So price is more than likely going to come down and take out this level of liquidity, maybe find a deeper order, or maybe go for another accumulation to build up more orders to continue up or completely fail the base and continue down. This is why this is a level of liquidity. Well, let's take a look at this example. So this is our base. Between this low and this high, prior to this, price been stuck here for a while. Price took out both external ends and dropped down. So that means this is our base. And if you want more information on how to find your bases and how to validate your bases, make sure you check our website. In the Market Penetrator, we covered everything, top to bottom. So since this is our base, the decision was made for sells. So once price broke structure, price tested this area one more time before dropping. So you always want to mark out your first interaction, right? So this is your first interaction. So this is your first interaction with the base. So this interaction explains why price dropped. So again, we can always go back to our dollar sign theory. There was a certain amount of money in this base that forced price to break down. So price had to come back, revisit this area to grab more sell orders to drop down. So let's continue. So now price came back to the base, to the exact same area, and rejected. So this rejection right here is taking more sell orders out and also created our equal high. So now we have two equal highs, which would be your liquidity now, right? So now, what do you think the next step is? If price does come back to this base again, it will more than likely continue up. And once you get in this area, you're more of a buyer than a seller. Why are you no longer a seller? Because all the sell orders are more than likely done. Because if there was a lot of sell orders in this area, for one, your movement out would have been a lot bigger and the retracement back would have been a lot bigger. And then once price would have broke structure right here, price really has no reason to come back all the way up here unless it's changing direction or trying to reject off another level of your base. So if price does revisit this area, this is liquidity and price will more than likely continue rallying. So you see buy orders counteracted. So as a bonus, I'm going to explain how to use true liquidity, which would be your liquidity derived from your base, to anticipate a reversal and completely switch your position. By position, I mean if you're a buyer, you can anticipate early how to switch to a seller, or if you're a seller, how to completely switch to a buyer. So here, this is your base and you already had your first interaction, right? So your first interaction was right here. Take notice. Something important happened here. This was not just a regular first interaction. This interaction right here broke structure. So what does that mean? That means the selling power in this base was strong enough to break structure. That means there was so much sell orders here, not only to push price for one leg, to push price for two legs, to even break a structure, to not only just break a structure, to form a shelf and then break it. This is tremendous power. So that means that there was a lot of orders in this base. That means there was a lot of orders. Big dollar signs, right? So what does this tell us? This tells us that this base might not have any more money left. Why not? Because look at the size of this move, and when price retraced, it had enough selling power to even make another big move, to even break a structure. form a structure and break a structure. So now this is valid liquidity, and price will be attracted to this level like a magnet. So think of this as a large magnet, and price will be pulled. So let's play on. So once you see this, which is a true change of character, where price made a new microstructure, that means there was a time frame shift here. Price broke structure and retraced back into another micro base to break structure again. So again, what happened? There was a previous structure, price came down and started a micro structure by breaking structure and coming back. So it wasn't just a simple character change. It was a character change with a base test, because we had our base here. We had a micro base here. And if you're watching this on YouTube, we covered this deeply in the previous lessons on the website. And if you're watching this from the website, then you've already seen the previous lessons that led up to this. So this is our micro base, and it broke structure. So that means this base, this micro base, not only had the power to come out of this range, it came back and tested it to prove that there's more buying power. So that means the institutions are injecting buy orders. So what do we know now? Even though the overall trend is bearish, but you want to be a buyer. Why do you want to be a buyer? Because the institutions are buying. What is the clue? The clue is our micro shift, which is respecting the base and starting to change character, and our magnet, our previous base that got used up for this move and this retracement to make another move. We know that there might not be enough money left in this base, so price is incentivized to continue above. And what can happen is price could come up, down, but we know we are buyers, so we're always looking for buyers. From here, from this high to this low in this area, we're strictly buyers. Why? Because this, once price gets to this area, it will more than likely continue above. Price made contact with our base. We know there's not enough orders. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you use the code ETM Army for 50% off of everything in the website, including the Market Penetrator course.